5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to this newest episode of the Follow the Money podcast, where we explore the intersection of economics, markets, and how you can make smarter decisions with your money. I'm your host, Jerry Robinson, and as always, it's great to have you with us today. So big news in the world of finance. Last week, we saw something we haven't witnessed in a few years. The Federal Reserve made its first interest rate cut since 2020. That's right, folks. After all the rate cuts we've been talking about for what feels like forever, we're entering into a new cycle, one that could have major implications for the financial markets, your investments, and, well, your overall financial strategy. But why does this matter? What does it mean for the broader economy, for stocks and bonds and even cryptocurrencies? We're going to unpack all of that in today's episode. And I'll be sharing some insights into how this new rate-cutting cycle might impact the markets going forward, and more importantly, how you can position yourself for what's coming. Later on in today's show, we've got a very special guest joining us, Barry James Dyke. Barry's a friend of the show, and he's got a brand new book out called The Retirement Ruse. And we're going to dive into some eye-opening truths about how Wall Street has been wreaking havoc on America's savings and retirement plans. And of course, we'll close out with a final word of inspiration to keep you focused on building a solid financial future, no matter what the market throws your way. So let's get started. Stick around. You're not going to want to miss this episode. All right, friends, let's dive into today's topic, something that's making waves in the financial world, and that is the Federal Reserve's recent decision to cut its benchmark interest rate by 50 basis points last week. Now, that's the first rate cut we've seen since 2020, and it marks the beginning of what could be a significant shift in monetary policy, a shift that investors need to be paying attention to. So why does it matter? Well, in the simplest terms, the Federal Reserve controls the cost of borrowing money here in the United States, just like every central bank around the world does in their own respective countries. And so when they cut interest rates, they make it cheaper for banks to lend, which in turn makes it cheaper for businesses and consumers to borrow. And the ripple effect of lower rates tends to spur more spending and investment. So let's break it down with three key takeaways from this new era of rate cuts that we've entered. Let's begin by first asking, why did the Fed decide to cut rates? You know, there was a lot of angst around this particular rate cut. In fact, many people have been wondering when the Fed was going to cut rates. Economists have been debating that for much of the year. And so we finally got the Fed announcing a rate cut at last Wednesday's policy meeting. And afterwards, of course, they also released their summary of economic projections, which we'll talk about here in just a minute. But if you've been following the economic data, you know that there's been a growing concern about the slowing economic growth here in the U.S. Inflation certainly has cooled down from its recent highs, but now the fear is that we could slip into a recession. Now that's been, banted about now for some time. The Fed's rate cut is simply a preemptive way to keep the economy on track. Think of it as adding fuel to the engine when the engine is beginning to sputter. And we're not really seeing a lot of sputtering engine here, really. I mean, again, when you look at the unemployment rate, it certainly is rising, but it's not at a level that would cause incredible concern. We also have the inflation rate slowing, and it's come down to a level that is much more comfortable for the Fed. And that's why I think we're seeing this rate cut. The rate cut we also got from the FOMC minutes back in July, the month of July, the last meeting. We saw that many of the Fed participants believed that it was time to cut rates, at least by about 25 basis points. And by the time we got to the September meeting, because there is no meeting next month, the next meeting, by the way, is November, the thinking was if we don't do two 25 basis point rate cuts here, we're going to miss our opportunity to do it in July. We won't have a meeting next month. So it really makes a lot of sense that they cut by 50 basis points. In fact, that's what the market was expecting. And you can tell that because the market rallied in reaction to these latest Fed cuts. In fact, we've seen the S&P 500 and the Dow Jones, and gold as well, hit all new all-time highs, recently. So the market is certainly enthused by the rate cut. And this is just the beginning of a overall rate cutting cycle that lies ahead. And this move shifts the federal funds rate to a range of about 4.75 to 5.0%. As I mentioned, that was the first interest rate cut since early 2020, but it is part of a growing global rate cutting trend that we've been seeing. Many countries around the world have already begun cutting their interest rates. We're seeing the fastest rate cutting trend right now that we've seen since the COVID era of 2020. And we've even seen long-term borrowing rates in response, mortgage rates have been declining, recently hitting a 2-year low. So these lower rates, I believe, are a signal that the Federal Reserve is prioritizing economic growth over concerns of overheating. In the past, rate cuts were used to spark economic activity, and the Fed is hoping to prevent any significant downturn by doing that now. I think it's a very delicate balancing act, but for investors, I believe it creates opportunities. And I want to talk about those opportunities here in just a minute. But the latest projections we got from the Fed, let me just give you a quick update here. The latest projections we got from the Fed in their updated dot plot and their summary of economic projections shows that they expect a median interest rate of about 4.4% by the end of this year, which means that they plan on cutting a full percentage point between this meeting they just had in September and by their final meeting in December. So overall, we expect to see a 1% decline in interest rates between September and December of this year. And then the Fed is expecting next year to end around 3.4% in terms of interest rates. So by the end of 2025, they expect that the interest rate will be down to about 3.4%. So that's a good 2 full percentage points down from where we are now. So the Fed has penciled in a rate cut for November of this year, 25 basis points. They penciled in another rate cut in December, 25 basis points. And of course, these are just market expectations. They're based upon the evolving economic data, and those are obviously going to change. Now, let's talk about some of the effects that rate cuts do have on asset prices. I mean, what does it mean for asset prices when the Fed cuts rates? Well, historically, when the Fed starts cutting rates, it's good news for certain investments. Bonds are a prime example. When interest rates drop, bond prices tend to go up because the lower yields on new bonds make older bonds with higher rates more valuable. And we've already seen a surge in demand for fixed income investments, with bond ETFs seeing record inflows as investors seek the safety of steady returns. And many investors, of course, were anticipating this rate cut. And so they got ahead of it by buying bond ETFs. That's been something we've been saying for much of this year to our members, some of these various areas. In fact, you may recall we did an episode of this podcast back in episode number 466, which was entitled 6 Markets to Watch When Rates Drop. And there we talked about bonds, and we talked about many other markets that we expected to do well in the with the backdrop of a rate cut, basically coming. Stocks also, particularly growth stocks, tend to benefit from rate cuts, at least in the short term. When borrowing costs go down, companies can finance growth more cheaply, and that can boost their stock prices. Now, that's particularly true when it comes to small cap stocks, because small cap stocks are companies that don't have the same kind of access to cheaper capital that large cap companies can get. These really massive companies can get access to money much easier because they have more assets and they have more goodwill and all of this. But small cap companies, some of the tiny ones, they desperately need lower interest rates so that they can be able to finance their operations at a cheaper place and make it more sustainable. And of course, when you cut interest rates, what you're ultimately doing is you're cutting the price of money. You're lowering the price of money. Interest rates are the price of money. And here in the United States, our form of money is the United States dollar, our currency. And so therefore, when interest rates do come down, you'll typically see the dollar index also come down. And when the dollar index comes down, when the value of the dollar begins to fall, then what that creates often is a tailwind for many different asset classes. Some of those being things, as we mentioned, like small cap stocks and bonds. Other things that benefit too from a falling dollar are things like gold and silver, right? And we've been seeing gold and silver do very well this year. Much of it due to the fact that the dollar has been coming down, and that has been helping aid gold and silver's price. Also, when you have declining rates, there are certain sectors of the stock market that do better, such as real estate. Now, real estate is very dependent upon lower interest rates, and real estate stocks and REITs, they all benefit from lower interest rates that makes financing cheaper. And so those kinds of stocks can also do very well. Companies that are also in the utility sector or the telecom sector, or even things like dividend aristocrats that pay very healthy dividends and have been doing it for a long time. Well, you see, as rates come down, savers will begin to look for other places to put their money. And oftentimes they'll look maybe for safe stocks. So they'll look for utility stocks, which are often considered safer than the average stock out there. And real estate stocks too tend to be relatively defensive. And so we will see more moves, I think, made into these areas. But we've already seen quite a bit of moves in these areas already, and we've been talking about them for much of the year. There's another area we expect to see also: solar energy stocks and clean energy stocks. They really benefit from lower financing costs for these capital-intensive kinds of projects that they do. We do have a growing demand for sustainable energy solutions, especially in the wake of the AI factories envisioned by NVIDIA. You've recently seen Microsoft recommission the 3 Mile Island nuclear power plant in order to power its growing demand for power for all the AI factories that it is running for generative AI and all of the things that it's doing. So there's a huge demand here for many different segments of the energy space that I think are also very well poised as we begin to see interest rates coming down. So let's talk about how you can position yourself in a rate cut environment. We've already given you some clues, right? We've already kind of laid it out, but let's just get a little more clear. So what should you as an investor be thinking about in this current environment? Well, first of all, you don't want to get caught up in the hype. Rate cuts do not guarantee smooth sailing. In fact, they often come at a time when the economy may be weakening. And so that can cause some sectors to do fine, but others could struggle in that kind of environment. So you want to be very cautious in this environment and not just assume that everything is just going to go straight up. We do expect that there's going to be plenty more upside as rates continue to come down, but there's also probably going to be some pitfalls to avoid, right? So you're probably going to want to be cautious around really high growth tech stocks. They are likely to rally and probably continue rallying, but they're also the very first to get hit if the economic picture worsens. Now, again, I don't see any immediate signs that the economy is moving into a very dark place overall. We've actually been seeing some improvement and some healing in the broader aspects of the market and of the economy. However, we also want to stay cautious, and we don't want to ignore precious metals, because when rates drop, as we mentioned, the dollar weakens, and that's bullish for metals, and we expect that they'll continue to move higher. We expect gold to hit $3,000 over the next 6 to 18 months. We expect silver to touch a new 2024 high once it breaks out above $32.75 sometime this year, and probably see it move on to maybe $35 or so before it goes higher. We also want to watch for opportunities in sectors that benefit from those lower rates. So again, we've been talking about utilities, which are the best performing sector this year, by the way, for a few reasons. Real estate, we talked about also. Those are areas to watch. And obviously, more risky and risk-prone areas like Bitcoin. Bitcoin obviously does well too whenever the dollar is coming down, as many people view it as digital gold. So, in short, the rate cutting cycle offers lots of opportunities, and we're really just getting started. They're just kicking it open right now with the very first rate cut. We got one more coming in November, another one coming in December, and then more next year, all things being equal here. So don't forget that we have just been through a long period of rate hikes, and the market is still adjusting to the shift from moving from these, elevated rates, now moving slowly down. The key idea here is to stay diversified. Don't put all your eggs in one basket, and be cautious in this environment. Don't just believe that everything is going to go up because rates are coming down. There will be areas that go up. There will be areas that don't. And so you've just got to be prudent with your investments. And at the end of the day, as I mentioned, this rate cut is just the beginning, right? The Fed has signaled that it has more cuts on the way and as the inflation rate continues to cool. And if we do enter a prolonged rate cutting cycle, history shows us that certain assets, like we mentioned, bonds and real estate and gold and Bitcoin, they just tend to do well, right? But keep in mind, investing isn't about reacting to every piece of news. It's about maintaining a long-term strategy and adjusting as necessary as the landscape changes. So that's where we are with this new era of rate cuts. It's an exciting time. It's a good time, especially if you've been wanting to buy real estate. Mortgage rates are coming down now. It's going to be a little easier for people to be able to finance because of costs and interest cost. But it's also a time that calls for caution. So you want to stay focused, you want to stay informed, and as always, you want to follow the money.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the Follow the Money podcast. Great to have you here. Joining me on the line today is our very good friend, Barry James Dyke. You have certainly seen Barry on our podcast before, heard him talk about his many books that he's written over the years. Not only is Barry a life insurance expert and has been in the retirement planning business now for many, many years, but in addition to that, he's written many books that the retirement industry oftentimes doesn't really know what to do with because he is not afraid to tell it like it is. And you're going to certainly gather that from the latest book that Barry has put out. It's entitled The Retirement Ruse: How Stock Buybacks, Cryptocurrencies, Unicorns, and SPACs Help Destroy America's Savings and Retirement Plans. Today we're going to be discussing Barry's new book. We're going to take a look at the forces working against the average investor. And Barry is no stranger to that topic, like his previous books, The Pirates of Manhattan, which many of you are familiar with. We've interviewed Barry on this show many times, and it's great to have Barry back on the show. Welcome to the show, Barry. Great to have you here.
Great to see you, and great to connect with you, Jerry, and God bless. Keep doing what you're doing, and keep educating people and pushing back the frontiers of ignorance. We need more people like Jerry Robinson in this country, and keep up the good work, my friend.
Thank you, Barry. I appreciate you so much. And of course, many of our folks actually met you in person at some of our Follow the Money summits. You've certainly been there. You've also been on this podcast many times. So I know many folks are familiar with you. I know some of you have probably even read some of Barry's books over the years. Well, this newest book, Barry just let me know he has a new book out, The Retirement Ruse, and I absolutely wanted to get him on the podcast to talk about this topic. Barry, let's begin by talking about this latest book. It tackles some of the complex, probably the most complex and difficult, troubling financial trends that we're seeing today. And to start with, can you briefly explain what inspired you to write this book and what you believe the most urgent message for people to understand about their retirement plans right now are and how they're being undermined? What inspired you to write the book, and why is it so important?
Yeah, well, I'm an American like everyone else, and I love this country. But when you understand the financial shenanigans going on with Wall Street and the asset management industrial complex and people's retirement situations today, for Main Street, middle income America, we're unfortunately we're a third world country when it comes to this. So there's no question about it now. In the beginning of the book, I get in through Mercer the actuaries, they're actually based out of Australia. Each year they do a comparison of the retirement plans preparedness of the top industrialized countries in the world, the top 25. And I think you probably know that where we sit in the top 25, Jerry.
I want to say, is it number 20, around number 20?
Yeah,
The
22.
last time I looked. Yeah, 22.
Yeah, so
Okay.
we've actually in the past year we've actually gone from like number 19 to number 22.
Okay.
And the thing is, when you understand it, is we have a real retirement crisis. There's a research which was released this year from Alliance from Lifetime Income. This guy Robert Shapiro, very bright economist, and he found that of the 30.2 million people retiring between 2025 and 2030, Jerry, of the 30.2 million, only two-thirds of them, the only source of retirement income they have is Social Security.
Mm.
So we may be able to, as a country, we may be able to build great bombs, but our retirement plans are horrific. I mean, I think we're next to Kazakhstan. The U.S. is, let's see, we know we're sandwiched between Hong Kong and the United Arab Emirates. Germany, Kazakhstan, New Zealand, all these other countries just far superior than us. And so the thing is that it's really important in any society how people save and how they plan for retirement. And the thing is, we're just third world. Now, that's not to say if you're really rich in this country, you're going to be fine. And if you're a public employee, if you're a teacher, firefighter, whatever, you have a true pension plan, you're going to be fine. But for the vast majority of people, they're gonna find it tough sledding.
It's a question of whether it's by design that way, or whether it's just been happenstance. We know how it began, or we know certainly part of how it began with the move from defined benefit plans to defined contribution plans. Get into that a little bit, because it does sound conspiratorial whenever you think about the fact that we are the wealthiest nation on earth, but the retirees that you're talking about oftentimes are just nowhere nearly prepared for it. How are we getting retirement so wrong? Before we get into the depths of this book, how are we just getting it so wrong when we're so wealthy and so knowledgeable?
Well, because it's just I think one of the major issues of this time, and actually, believe it or not, I was actually having dinner last week with actually a billionaire, believe it or not, and he's a friend of mine. It's a long story, but and I think the biggest issue today is not climate change or any of that silliness, but real is economic inequality, and by design, the systems today are really to favor the top 1%, 10%, if you will. And I'm a small business person, and I'm a capitalist at heart. But when you understand how the game is rigged, you have to. I mean, for me, and there's some section in the Bible that says, I think it was James says, if we know wrong and don't report it, it's to sin. So that's the way I felt about this. But so it is by design, and it's also to enrich I call it the asset management industrial complex, Jerry, which would be essentially the same people who brought us 2000, the collapse of 2000, the dot-com meltdown, the same people who brought us the 2008 subprime crisis, and so it's getting more and more obtuse and very, very complicated, even for me. And I'm saying, if it's complicated for me, how is it going to be for the average person? And when you start looking at the other countries, how far superior they are, I said, well, heck. So with the blessing of the internet, I was able to research how other countries work, and we're backwater. Unless you're a government or a public employee or you're very rich. So that's the reason why I had to do it. It's very, very important for people to know.
Yeah, in your new book, The Retirement Ruse, by the way, you're listening to the voice of Barry James Dyke, the author of The Retirement Ruse. You can find Barry, by the way, online at barrymajamesdyke.com. That's DYKE.com. And now, in your new book, The Retirement Ruse, you argue that stock buybacks have played a major role in destroying America's retirement plans. This is often a headline that is often cheered by investors when they hear that a company is buying back its stock. So can you explain why the buybacks in particular have harmed long-term investors and retirement savers?
Well, I stumbled as I was introduced to a guy by the name of William Lazonick, who's probably the buyback expert in the world on this, and he was able to use some of his research for the book. But roughly, which I was amazed, Jerry, that roughly 50% of all market participation is companies repurchasing their own shares, which I was like, wow, this is wild. So it's not retail traders, it's companies that are buying back their own stock. And why would they do that? Well, instead of deploying money into, say into new technologies or better employee benefits or new markets, I'm finding that so much of this is going into to reward investors, if you will. But the reason, really the primary reason, is because executives, and anyone can go on Yahoo and figure this out, is that most executive compensation is based on stock. So by reducing the number of shares outstanding, theoretically the price goes up. but what I was to find, though, a lot of this is and actually stock buybacks, Jerry, were actually illegal in this country till 1983. It was Ronald Reagan who kind of opened up the door for an investment banker, and actually they're illegal in the UK and discouraged in Canada. But we're going on, they're at full force now in this country. And so the whole thing is that, so I guess maybe if I was executive, I'd want to buy back my own stock too. But what the irony of the whole thing is that, as I found, a lot of these things are, these buybacks are being done and that they're still having disastrous results. For example, Lehman Brothers bought 2.7 billion back of their stock before they imploded. And the Credit Suisse, the Swiss bank that goes from one scandal to the next, actually, and I got this off their website, they purchased 13 billion of their own stock, and they went into such a receivership, And then I also analyzed what GE did and Intel, which is having a really difficult time, and some other companies. They're actually going backwards. So yeah, it does work that sense, but not always. And the point is that this is really for the top 1%, top 10%. And so I'm not saying it's a totally bad thing, but it's just people just do not understand it, and it's huge. It's unequivocally huge. And actually, I have the public data on it. A company like Apple, I'm a big Apple user. They have purchased back close to 700 billion, $750 billion of their own stock. So Tim Cook can make another couple $100 million a year. So anyway, so people really need to know that, because while it rewards Tim Cook, and it surely does, most people are having a real hard time in retiring, unless they're very rich.
One of the other topics that you've long talked about, been a vocal critic of, are 401ks. And I think most people listening, they may not be fully aware of stock buybacks or SPACs. I want to talk about SPACs too, but they certainly know about the 401k. And how have modern trends with the 401k made them worse? We've certainly talked about the 401k in the past, and I'd like for you to talk about your views on it, but with the introduction of SPACs and the unicorns that you talk about in the book, talk about how these have further jeopardized the retirement security of Americans and what's driving these trends.
Well, I always tell people that, and matter of fact, you're in Arkansas, so I always tell people that a new toaster from Walmart has more guarantees than a 401k. Right? and when you understand it, and I do, okay, and that's very true. And the thing is then when you understand the 401k, most of these 401ks today, Jerry, are in what's called collective investment trusts. Are you familiar with those at all?
I've heard of them, but I couldn't say I was too familiar with them.
Okay. Now, the reason why I bring this up is collective investment trusts are essentially they don't even have to be registered with the SEC. They're either
Mm.
regulated by the insurance regulator or by banking regulator. So there's no disclosure really required on collective. So roughly more than half of all 401ks are actually in collective investment trusts today.
Mm.
I think there's like close to 5 trillion 401ks outstanding. I think like 2.86 trillion of those funds are in collective investment trusts. So you have these it's gotten out of control. And so you have with the collective investment trust, the reason that they want to use those so they can stuff in things like private equity or hedge funds and things like that. And there's cases ongoing about with Intel about how they stuff private equity in hedge funds into 401k. So what was supposed to be retirement income program, Jerry, which is the most important thing of a retirement income plan is to produce retirement income, is turned into another casino on wheels. And I start the book with the quote from Louis Brandeis and said the oligarchs build these things with other people's money. And so the ultimate pool of money today is the 401k. And so then when you have the passive investing companies like Vanguard and Fidelity and State Street, and BlackRock being the biggest, there's no accountability anymore. So the whole thing is that and people think the indexing is a great thing to do, which it is, but people don't realize that in 2022, BlackRock lost 1.7 trillion with the T of other people's money in 401ks. So the whole thing is that people really need to have a true retirement income, Jerry. They really need to have some type of seat belts and guardrails around their money. But in the United States of America, that's not the case.
Yeah, when I first came into the insurance industry, when I first began, I first got my license. I came from that economics background, so I read a lot, and I certainly got into learning more about the background. And what I learned, as you well know, is that insurance and guaranteed products were the introduction to financial planning, and it kind of fit because back in the day we had our defined benefit plans, we had guarantees, and we actually focused upon income. That was the whole point of retirement planning. In essence, was to create an income, and today it seems like we've gotten away from that concept, and instead it's more about, as you pointed, the casino. How much can I make total? And that's understandable. We all want to have a nice big pot of gold at the end to draw from. But as you point out, there's so many missteps that people can take now, and it could work out okay for you if you get lucky in the casino, of course. But so many people end up getting to retirement, and the amount of income that they need is just not there. As you pointed out, many of them are relying upon Social Security for their income as their only income stream. So it is a shame. It is a shame that we have this much knowledge, this much wealth, and it seems as if greed is stealing from us. And perhaps even they're tapping into our own greed, Barry. It's not just their greed, but it's them tapping into our own greed. Instead of simply saying, look, let's get a product, as you pointed out, that has guardrails and that is going to have protections and have guarantees, we often are steered into the products that offer none of those. And as you're pointing out in your book, it's because of money, right? It's because of who makes the money in the end. The assets under management are obviously a huge industry, as you point out. So when it comes to, let's talk about insurance, because you're an expert in this area. You've been doing this for a long time. We've been working together now for many years in this same topic. Let's talk about how some of these products can actually help individuals. So if you don't want to put your money into the casino, let's talk about other products that actually can protect you.
Yeah, so the whole thing, this goes back to like my original research, and I think I told Dave Walker I'm doing a guaranteed income too. But so in the end of the day, Jerry, any pension or any Social Security is actually an annuity. So because it guarantees a lifetime income stream. So we know that, and I've been doing this long enough to realize that people have very few problems when they're actually retiring. They're actually very, very happy. So I have the track record to back me up, but the purpose of retirement plan, again, is to generate retirement income, and we've gotten so far away from that. The thing is that so what has happened is that the growth of a now, if you study the countries abroad, and I'll be putting this research out there for everybody. You really countries that have really good retirement plans, i.e., the Netherlands or Iceland or Finland or Israel. Even actually, Israel is one of the top. They're all annuity
All
based.
annuities, every single
They're
one of them
all
are
every
annuities.
single one of
Yeah.
them. You know,
Yeah.
and so there's actually another economist, Teresa Garaducci, out of New York, the New School in New York, whatever. So when you understand, this is really the most important thing for people to have is an income stream. Because if people get old, they have a cognitive decline. They things like dementia sets in, and other things like that. So, not that it's a panacea, but when you understand it, it's much, 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 much better than what we have.
Mm-hmm.
And our system is horrific. And so this is but anyway, I was also in that movie. Have you heard about the baby boomer dilemma, Jerry?
Mm-hmm. Yeah, I heard about that. You're in that movie.
Yeah, well, I was in the
Okay.
movie, and I was kind of edited out of it because of the research I came out with. But yeah, I get Ted Bennett in there, who's the guy who created the 401k, and
Mm-hmm.
Dave Walker and Ted Siddell and things like that. So yeah, so that was kind of the thrust of that movie. So, but what I'm just saying, even another step forward, is saying if you're going to do this with annuities, do it with fraternals and mutual companies, and really kind of watch out for private equity backed companies. So this
Mm-hmm.
is going to be coming out in the research within the next 12 months or so.
Yeah, and that's so important to bring up is that it's not just any insurance
Yeah, you
product.
can.
It's not just
Yeah.
any insurance company, so to speak, right? You've got to really do your due diligence. Just
Yeah,
like
yeah, yeah. You have to go high quality, Jerry. Okay, because a lot of this stuff is not going to end well. What we're seeing now, and this is, if you don't believe me, you can Google this with the IMF studies and the Federal Reserve, and I told you my friend Tom Gober's research. They're domiciling a lot of these companies offshore to manipulate reserves, and in Bermuda. And it's anyone doesn't believe me, Google it. And so yeah, you really want to have high quality stuff. It's like if you're a good carpenter, you really want to start out with the best products, the best raw materials, or if you're a chef, if you will, you want to start with really good ingredients. So I'm saying you're really best off using an old mutual company or a fraternal. But there's no question about that.
Mm-hmm. Yeah, these mutual companies are, for those who are listening, saying, well, what does that mean? Well, that would be a company or an insurance company that is actually owned by the policy holders as opposed to being a stock traded on Wall Street, which then, of course, creates kind of two masters, so to speak, right? Where you do have the shareholder that is required by law to be satisfied and to be taken care of. We do like those mutual companies. Now, as we bring this to a conclusion, I'm again looking at this book. For those listening, obviously, many people know that there's a problem, and many people are concerned about retirement. They don't really know, Barry, many of the things that you've learned. That's why I encourage them to read this book, The Retirement Ruse. But let's just conclude by talking about maybe some actionable steps that people can take who are listening to this before they buy the book. Right now, what are some actionable steps that the average person listening to this today can do to safeguard their retirement, their financial future, especially given the risks that you highlight in the book? What are some action steps?
Well, so something obviously you get educated, and as you know, I still do work, believe it or not, all around the country through CFAN. But first of all, educate yourself. Don't take my word for it. There's a lot of other good research out there. I think some of mine's kind of some of the best. It's not that I'm any better. It's just I work very hard at it, and so I think really kind of thing they could contact us if they need be. And we do business in all the states within the country, but also and learn how to simple things like saving instead of investing. The problem is today we have a language problem, Jerry, where they treat all savers as investors, and that's not true. There's a huge difference between savings and investing. But as far as Wall Street and the asset management industrial complex today says we're all investors, and that's not true. And so I think really, I think it's really, you really want to think for yourself, because if you understand all the shenanigans which have gone on with Wall Street, really no one's really gone to jail really for anything. There's only one banker I know of that went to prison, was a guy from Credit Suisse, and then Credit Suisse ends up collapsing. So, but to the best of my knowledge, no bankers or no one from the asset management complex have really have served any time. And the speculation is crazy, Jerry. Was it last week NVIDIA, which is the hot stock now, the AI? That's the latest bubble. I think NVIDIA lost something like 286 billion in valuation within 1 week. It was the largest drop of a stock value in U.S. history, in entire stock market history. But people are in and out, and they're gambling. And the thing is that, and I'm not against investing, but it's like we're all turned into soldiers gambling at the feet of Jesus when he was on the cross. So it's gotten that bad. So I'm just trying to help people be aware of it. So go to barrymajamesdyke.com. You can even, don't have to buy the book. We'll keep you informed, and if we can help your listeners, we'd be delighted to do so.
It's fantastic, Barry. You just keep educating. You just keep going. When I got this book in the mail, I chuckled, because I thought to myself, how does he have time to continue to service so many clients around the country and take on new business and continue to write books? You are possessed by love, my friend. You are driven to educate people on these topics, and I appreciate your passion so much. Folks, if you're listening today and you want to learn more, I encourage you to go out and pick up a copy of the Retirement Ruse, How Stock Buybacks, Cryptocurrencies, Unicorns, and SPACs Help Destroy America's Savings and Retirement Plans. It is a big overview, as you can tell, but you really want to educate yourself on these kinds of things, especially if you want to have a retirement that can last. And so I do encourage our listeners to go pick up a copy. And Barry, I just appreciate you so much. I do encourage folks to reach out to you. BarryJamesDyke.com is where they can find you.
Yeah. Make sure they go. I don't even put the book on Amazon yet, because I'm kind of developing a social media campaign yet. So they can get, the best way is to go through the BarryJamesDyke.com, because I haven't even put it on Amazon yet. Actually, some other books, Jerry, there's some used copies of my books are selling for $150 and things like that. I'm really amazed. Yeah. So, but as you know, it's fun to help people, and it's a blessing.
Mm-hmm. Well, you're certainly a blessing to others, and you're certainly helping others. So again, be sure to pick up a copy of this new book. Barry, it's been great to have you on the broadcast today. Thanks for joining me.
Thanks so much, Jerry.
Friends, that brings us to the end of another episode. Today, we've covered some important ground, however. We started with the Federal Reserve's first rate cut since 2020, and we discussed how that move could ignite a new era for financial markets and which asset classes stand to benefit from that shift. From bonds to precious metals, Bitcoin, even real estate, the market is shifting, and now is the time to be prepared. And then in segment 2, we had a fascinating conversation with our good friend Barry James Dyke, the author of The Retirement Ruse. Barry shared some eye-opening insights about the pitfalls of modern retirement planning and his perspective which I greatly appreciate, serves as a powerful reminder that we all must stay vigilant and informed in a rapidly changing financial landscape. If you missed any of it, I highly recommend going back and listening to the interview. And that leads me to our final word for today, which comes from the legendary management thinker Peter Drucker, when he said, "The best way to predict the future is to create it." I love that quote because it speaks to the heart of financial independence. We may not have control over the Federal Reserve's decisions. We may not have control over the broader economy, but we do have control over our own financial choices. You shape the future with the decisions that you make today, whether it's staying disciplined in your investing, building diverse income streams, or preparing for life's unexpected turns. It's so important to stay informed, stay proactive, and most importantly, stay in control of what you can without worrying about all the things that you can't control. Remember, the future doesn't just happen to you. You create it step by step. And that's just something to think about. As always, friends, when you want the truth, just follow the money. Have a safe and prosperous rest of your week, and I'll look forward to seeing you right here again next time. Until then, God bless.
Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussion on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any